So it looks like bondholders are letting some bad habits creep into their buying decisions. We've got all sorts of things happening in the bond market where they're buying really risky securities. They're not necessarily being paid for the risk. They're also taking on things like dividend recaps, all the things we saw before the bubble burst. So, Agnes, you've looked into this.
Yeah.
Tell us a little bit about what you're seeing.
Yeah. I think first, it's not like we're going back to the boom years. That's not happening. But what we are seeing, and we see this again and again, is every time a market starts to boom, there's this tendency, particularly in a low-rate environment, is everybody needs yield. Everyone's
right.
looking for yield. So where do you go? You go to the riskiest type of bonds, where that got beat up last year.
What are we talking about when we say risky bonds?
We're talking triple C. Is what the rating is.
So really like high yield or
high yield,
super high yield,
yeah,
super high yield, really high risk.
One or two more notches down, you're in default.
What kind of companies are
and
these?
Historically, well, we saw earlier this year, we saw Clearwire Communications, we saw Realogy. These are names that also come from the boom time and are still kind of trying to work out their capital structure.
And Realogy was in a leveraged buyout.
Exactly.
Clearwire was a sort of venture capital type investment.
And they found buyers for their debt. And again, a lot of this stuff is refinancing. So, technically this is good for the companies, but again, I think investors have to start worrying about or start thinking about you're getting into this debt, and right now it's super easy. There's liquidity, you can get the bonds, but we're also looking at possible inflection points.
So one way to look at it is the spread, right? So if you look at the spread on some of these really risky bits compared to other elements, other strata.
And one measure of this is just looking
yield.
at like this compression between like higher rated junk bonds and these junky bonds, right? And that is just really compressed.
It's coming by about a fifth this year.
Exactly.
Well, give us some numbers. What are we talking about?
Yeah, it's about 170. It's like
the gap between them is about 190 basis points, 170 basis points.
About 170 basis points. But when you contrast that with like safer bonds, and they've come in about 3 basis points. So again, you're really seeing that's where the focus is going.
Everyone's looking down the scale, as they always do when you think the economy is improving.
Yeah.
But, everyone's been reacting so much over the last couple of years to every single event, and now, Europe looks a bit better. The US banks have mostly passed the stress test or not failed badly, and everyone's feeling a bit more willing to have a look around.
So the view is then that the risk of default is coming down as the economy is growing. The ability of these companies to pay back their obligations is that people
that's what you have. Maybe it's a great bet.
And it's a way to make yourself feel better,
what about
frankly. But again, I think that there's still a lot of headwinds out there, and the other reality is this stuff is still low. We call it high yield, right? But it's still low yield. When we do actually start to see interest rates like U.S. Treasuries, which we saw last week, start to rise, eventually people are going to be like, why am I holding this risky debt?
Why am I holding risky paper at 7%?
Exactly.
When yields are coming up.
Exactly.
And I'm stuck into something that's
and this is ultimately the issue that everybody knows about. Is just at some point you're not going to want to hold these bonds. And also, you have big institutional investors who are buying them for the yield today.
And don't forget the cycle we're in as well, where it's not a lot of these companies are buying for sort of 5, 6, 7 years, maybe 10 years, some of them. Yeah. And actually, economic cycles these days generally have us lurching into some kind of economic event every 4 or 5 years. So, they're refinancing now, but what happens in 5 years?
All right. Well, thank you very much, both of you, and we'll be back with more Breaking Views tomorrow.